Okay, so hello everyone. Welcome to this class, which is about accounting for pensions. And this class is relevant. This topic is relevant because of two reasons. First, this is relevant for sustainability because it takes into consideration the social dimension of sustainability. This means that accounting for pensions is part of the social and the people dimension of sustainability. So this is why it's important for this course. And second, this topic about accounting for pensions is related to the methodology that implicates showing sustainability in the financial statements. So this is a technique where the accountant can actually show outsiders and insiders of the organization that the company is taking care of their employees, of this social dimension, but in the financial statements, right? So this is something important. Remember that we have two methodologies. One is with the independent report, and the other one is reporting sustainability through the financial statements. So this technique, this topic is about the financial statements. So maybe the first question that comes into your mind is, why is it important to register labor liabilities? So why is it important to account for pensions? So the logic is that when an employee works, he gets paid, right? So you have an expense. But also when that person is working, at some point he or she won't be able to work at some point, right? Because maybe the age or getting he or she is getting sick. So there is a responsibility from the employer to provide that person with an income after that happens, when that person retires because of age or because of um, or because of an illness. So this is the reason, right? Like when someone is working for you, for your organization, you have to report that because it's your responsibility. Like the time that that person is working for you, of course, it's a salary, it's an expense, it's normal, that thing. But also you have the responsibility to take care of that person once that he or she can't work anymore. But there are two types of labor liabilities, or two types of pensions. And here is where I think it will make sense to you, especially if you are already working. I think that will make click in your head. So there are two types of pensions, basically. We have one that is called defined contribution, and the other one is defined benefit, right? So defined contribution, I will start with that one because I think it's the easiest one and I think it's the most simple. So the defined contribution plan is the one that maybe you know because it's the one that IMSS uses. In the defined contribution plan, the amount that the company pays is fixed. It's always the same. That happens with IMSS, right? You pay the same for the pension fund. So the what is defined is the payment, right? This is the fixed amount is the payment. However, it is not clear how much that person is going to get in the end. It's not fixed, it's not defined, it is variable, right? So what is fixed is the payment, what the company pays, and the outcome, the benefit is not defined. So this is the first characteristic of this plan. Also, in this type of contribution plan, defined contribution plan, there is an independent entity that manages the money, right? It's like with IMSS, right? Like there is an Afore that takes care of that. However, the other one is the more complicated one. I think this one will make sense because it's the one that we usually know. Maybe it's the one that you have if you work. That's the one that I have because I work at tech. But the defined benefit is a little bit different, and this one is somehow getting more attention. At some point, maybe 50 years ago, this one, the defined benefit plan, was the most common plan, but it changed to this one, and now this one is coming back again. So in the defined plan, the logic is different. Instead of having a fixed amount that the employer is paying every month, is different. That amount changes every month, but what is fixed is the amount that the employee will receive in the end. So what is fixed is the benefit, but the payment is not fixed. So this is also interesting, and that's what we have to do. And that's what we're going to learn. How can we report on this? And finally, it's also an independent entity. It's not the same company, the one that manages the money. It's also an independent entity. And in the end, the company is responsible for the money that the person will get in the end, in their retirement. So in this one, the responsibility is on the employee, right? Because if something bad happens with my pension fund, then I won't make a lot in my pension. But in the defined benefit, I don't really care as an employee. The one that will be paying more if something bad happens is the organization. So I think I will stop in here, and in the next video, I will explain some important characteristics about these two plans.